Okay, we have just come out of a very busy week for the dollar. We had some pretty important news yesterday with NFP and unemployment. So what I'm going to do is break it down. I'm going to explain this reaction here. We're going to have a look at the Fed tool and possibly what's going to happen to the dollar over the next couple of weeks as we head into the Fed cuts and what Fed cut I am expecting, whether it's 50 or 25. Initially, we had pretty bad news really for NFP. So what we had was, we had a forecast or a consensus of 160k, which would have been very good for the dollar. This would have signaled a relatively resilient labor market. However, we didn't quite get that. We got 142k. So on the face value of it, the result we had was obviously a lot less than our forecast. So generally speaking, on the surface things, you would expect the dollar to be bearish. And we did actually see that with this candle here, but it didn't stay. So you can see following this bearish candle, we had a lot of indecision, wick to the upside, wick to the downside, followed by a pretty strong bullish candle after. Now, one of the reasons for this is because we had a revision from previous numbers. So previously this number was 114k. So when you take a look at NFP results last month, we had 114k. So you can see the little tab or the little highlight on screen now revised from 114 down to 89. So again, that does seem very bearish. However, when we just have a little critical think here, if last month's was actually 89k, so back into double digits, or when I say back into, it was in double digits. So when we see 89 and then we get a result of 142, the difference here is quite positive. Although 142 in the grand scheme of things is still very low, it's not positive. It is positive in relation to the previous result. Now, another pretty positive factor was the unemployment rate here. So unemployment, obviously the lower the number, generally the better. Obviously if it starts going too low, then it is a bad thing, but 4.2 compared to 4.3 is a good, again, displaying a resilient labor market. So that can explain why we did see an initial move to the downside, but it wasn't sustained. And then we saw the push to the upside, obviously with a slightly higher NFP and also positive unemployment numbers. So if we go ahead and look at the Fed Watch tool here, this has been jumping all over the place recently, this 50 basis point cuts expectations. This went up to 55% yesterday, and I checked again this morning and it's gone down to 30%. So we're seeing, not a very convincing reaction really, because like I said, this 50 basis points jumping all over the place. It was at almost 70, then it went down to 30, then it went to 55, now it's back at 30. However, at the moment of making this video, the favor or the most expected is a 25 basis point cut. And I am also in that ballpark. If we had the US news come out yesterday, and let's say NFP came out also in double digits, let's say 90k or 85k, it doesn't really matter. And we had unemployment come out at 4.3, 4.4, 4.5, this would have been terrible. This would have been really, really, really bad. And it would have been more looking towards a 50 basis point cut. So let's have a look at some of the data for the US right now. So if we look here, this initial number hasn't changed, but you can see the revision again is 89k. We are starting to move up in NFP again. So we had pretty, 3 months of downturn really in NFP. And then, now we are potentially starting to move up. ADP also was very, very bad this month. We had 99. Bearing in mind the forecast was 144. Unemployment claims are stable, and this is another sign that the labor market isn't necessarily falling apart. Job openings is declining. You can see we are in a downtrend. However, it's not falling off a cliff. So this isn't necessarily healthy, but again, it's not a red alert situation in terms of there is no jobs coming, unemployment claims are skyrocketing, etc., etc. Now what we have here is the unemployment rate in the US. So again, we can see this is trending to the upside. However, this month it's actually taken a bit of a dip, and this dip has come for the first time since December 2023. So again, this is quite positive. Although, unemployment rates, even this 4.25 is still pretty low. It's not like a huge amount of people are unemployed. However, relative to the data we see, it is still quite high. Wage growth as well is also on the decline. Again, we did see a slight pop this month. So it seems like this month data seems to have had a very, very small turnaround. Going back to the Fed cuts, this hasn't changed my idea. Yesterday, actually, initially, I was starting to lean on this 50 basis point cut. And I took a step back, reviewed some of the data that I just went through with you. And then I'm still slightly leaning towards more of a 3 cuts of 25 basis points. So again, we'll have to keep an eye on this, but for now, there's not too much going on. So another thing we do need to pay attention to here is we've got CPI on Wednesday for the US. So we've got core CPI month on month. We've got CPI year on year, CPI month on month for August. Crude oil inventories won't really come into play too much with rate cuts. We've got initial jobless claims as well for the US and PPI. So next week will also give us a bit more of insight in terms of inflation on what the Fed is going to do, because we know that this set of rate cuts is more based on unemployment or the labor market, rather than inflation. Obviously, we've had most of the labor data out of the way. As I said, we do have jobless claims next week, but we also mainly have the inflation data. So what can we actually expect on the dollar? Or what do I expect on the dollar? I actually expect a little bit of a reversal. So what we can see is this level held up really, really well. So we've had this sort of range between 101 to sort of 104. What we had was actually not terrible news for the dollar. I mean, again, it wasn't great, but it's not the end of the world. It's not like we're ringing the alarm bells of the US is going to crash. So I do see us pulling back on the dollar at some point, and to somewhere. Now, where? I don't know. Maybe to this sort of 50% pullback level, maybe higher. However, when we do start seeing Fed cuts, I do expect us to start seeing some downturn on the dollar. Now, I don't see us falling off a cliff. Again, I'm not sounding the alarm bells on the dollar. I am more expecting something potentially like this on the dollar, where we start coming down maybe to around this level, maybe even possibly a little bit lower, down to around 97. But again, I'm not necessarily a perma bear. I'm not looking to start really shorting the dollar. And this is a big misconception, actually. Rate cuts are viewed as negative for the currency. But what are rate cuts? Why do they do them? Well, they do it to stimulate the economy. It's not necessarily we're going to start reducing the value of the currency. It's a case of we need to help what's going on in the US. We need to help the people and help whatever situation it is they're trying to fix. So obviously, if that goal is achieved, the value of the dollar should stabilize. In theory, of course. So this is currently the plan. I am short on euro dollar. However, this is more of a hedge into rate cuts. I am also looking to take the pound dollar to the long side, again, sort of hedging the dollar both ways. So I would like to see a pullback into this level of previous support. Actually, let me change my squiggly line here. Something more along these lines. So we come back down to the previous level of resistance at 1.3, and then we start heading back to the upside. Now, the institutional target of 1.36 is still intact. We've not quite reached there. I can't remember which bank put that target out, but I know that was a target, and I'm still looking for that to get hit at some point for the rest of the year up until December. Now, if we look at seasonality, so on the seasonality, if we draw it from the start of September until the end of September, we see we have this initial push to the upside. However, if you pay attention to where the peak of this is, it's on the 18th, and that's exactly when we have the rate cuts. Now, of course, seasonality doesn't predict rate cuts. It doesn't really come into play at all in terms of data releases. However, if we are going to use seasonality and we draw it from the end of September and we draw it sort of mid-December, we could catch a relatively nice move to the upside. Now, of course, this does depend on what the Fed decides to do. If they start cutting rates aggressively, then this trade won't really have much potential. This trade will have some potential. However, we will see. It's a bit early to really start planning trades around it, because obviously the Fed hasn't really given us much signals on whether it is going to be a 50 or 25 cut. So pay attention. Obviously, I'll make some videos when we do come closer to the rate cuts, and keep you guys updated. When we do get the rate cuts, obviously I'll make another video and explain what the plan of action is and how you guys should start to look to navigate the markets.